Welcome to the October 2025 portfolio update for the CPF Property Debt Fund and the CPF Real Estate Credit Fund. My name is Joe Christie and I'm joined today by my colleague Xander Ryan.
Well, I think we'll start with the land subdivision category that we have. So we've got a few loans at Spring Creek. We've got Spring Creek Stage 6, which is a first mortgage paying 10%. We've got Spring Creek Land paying 9.5% for a first mortgage. We've got Spring Creek East paying 10% for a first mortgage. Spring Creek East and Spring Creek Land, they're just land loans, so there's no construction. And with Spring Creek Stage 6, they're developing 62 residential land lots. In October or the coming month, there will be a Stage 7 coming, and that'll be approximately 50 lots. So that's something to look out for if people are looking for more exposure to Spring Creek. But apart from that, Spring Creek is continuing to perform. There's been construction draws to fund the construction of the 62 land lots for Stage 6. Anything to add there, Joe?
No, look, nothing really, Xander, other than say that demand for the finished product has been strong. They're struggling to keep up with supply. So I would expect larger stage developments coming in the not too distant future.
Moving on to Walloon, we have a first mortgage paying 10.5%, and it's Walloon in Ipswich, Queensland. They've just put in their first construction draw, and works are going really well, and we're very happy with how this loan's performing. Moving on to Toowoomba, Park Hill Stages 4 and 5, we've got a first mortgage paying 11% and a second mortgage paying 18%. This is a 47 land lot subdivision. It's going to expire in November this year, but due to a bit of time taken to get their works approval, they will need a bit of a slight extension, and we'll be communicating to unit holders in this loan about that extension soon. There was a bit of an update on sales at Park Hill. Joe, could you tell us a little bit about that?
Yeah, thank you, Xander. Look, very good news, I'll be honest with you. When we originally set the loan, we underwrote the loan on around about $240,000 per lot price expectation for the completed land lots. We're pleased to say that we have a conditional sales contract for 100% of the completed land lots at an average price of $370,000 per lot. So it's a very strong increase in price, and it de-risks the project. So investors in that loan will continue to get their 11% return, knowing or having confidence that they've got 100% pre-sales achieved.
It's an extremely good update. Moving on to Port Douglas, we've got a first mortgage paying 10%. We've communicated in previous updates that Terry McKinnon, the sponsor, wanted to diversify the offering here by building 2 spec homes to just increase sales activity. And this, even though he hasn't pre-sold any of the spec homes, there has been an increase in activity. Joe, could you add some flavour to this?
Yeah, thank you, Xander. I mean, it's 22 completed residential land lots, and as we speak today, we have 4 sales. So it's quite a low LVR at around about 54%. So fairly soon, if this sales rate continues, we'll have 100% debt coverage in the not too distant future.
And then finally, Musgrave. So this is in near Paddington, Queensland. We've got a first mortgage paying 10% and a second mortgage paying 18%. No real updates. We had those 2 offers that we communicated last update, but since then they're just working on getting titles issued, and then once those titles are issued, repayment will the unit holders in Musgrave will be repaid. So no real updates from then. Moving on to the commercial portfolio, so I'll start with Brookwater. We've got a first mortgage paying 10.5% and a second mortgage paying 18%. That second mortgage LVR is at 80%. The council requested a bit more information from the sponsor, and in September, all that relevant information was given back to council. So we don't see why that works approval that they're waiting to get won't be approved in the coming week. So we expect that soon, and then construction will be able to begin at Brookwater. Anything to add there, Joe?
Look, the only thing I say is that it's a childcare centre, a good demand for the finished product, and you've got government underwriting some of the exposure there. So look, we like childcare centres.
Moving on to Paddington, so we've got a first mortgage at 10% and a second mortgage at 16%. This is a childcare centre with an underground car park. In the last month, they've appointed a new builder. Joe, could you tell us a little bit about this builder?
Yes, thank you, Xander. Look, they're taking on a builder that is specialised in new structures around existing heritage-style buildings. So they've interviewed a lot of builders, they've done a lot of research, and they're very, very happy with this particular builder because they will suit the circumstances at Paddington perfectly, given that you've got heritage-style existing buildings, and then they will be building around those. And this particular builder will actually apply for the construction certificate on behalf of the sponsor.
That's a great update. Moving on to the industrial portfolio, so we've got Tingalpa. We've got a first mortgage paying 10.5% and a second mortgage paying 18%. It's 21 industrial units, and in September, practical completion was reached, and they've submitted plans to the council. Could you add a little bit to that, Joe?
Yeah, you covered it quite well. Plans have been submitted. Hopefully titles will issue shortly. Once titles issue, the sales contract become unconditional and you'll start to see that loan repaid quite quickly. The only thing to add is that as of today, 100% of all the completed units have now been sold at very strong prices. So sad to see that one go, but it is going to leave us, and hopefully that sponsor will come back with another project shortly.
And for those, we're expecting in the next 3 to 4 weeks, hopefully, that repayment will be made for that one. And then on Mark's Drillage sponsor, we think there will be other industrial developments. He is looking for sites at the moment, so hopefully we'll have a new Tingalpa shortly. Moving on to the residential portfolio, so I'll start with Markula. We've got a first mortgage paying 10.5%. All the approvals are in place for this one. They've demolished the original dwelling there, and they've appointed the builder. So they're going to start construction of the 2 new duplexes there. So no real updates to add on Markula. Moving on to Tingalpa. We've got a first mortgage paying 11% here. In New South Wales in September, we had a good stretch of weather, so they were able to do a lot of work. They've poured 4 of the concrete slabs for the sites, and they've completed approximately 90% of the civil work. So as we've been saying, when the sun is shining, work is very good at Tingalpa. We've just had that bit of rain delays there, but no, we're extremely happy how Tingalpa's going, and if this good streak of weather continues, they will need a bit of an extension, but we've got no issues with giving them a bit more time just due to the rain. Anything to add there, Joe?
I think you've covered it quite well. Just that values have come up a little bit on the completed stock, so there's a little bit more comfort/wiggle room around the loan to valuation ratio, which will be reflected in the rollover, which will come to investors shortly.
And we are getting an updated valuation, an independent valuation on that. So when that loan does roll over, we might see that LVR tick down slightly due to that increased valuation there. Moving on to, we had 3 new loans in September. I'll start with Bowral. So this is Bowral in New South Wales. We've got a first mortgage paying 10% and a second mortgage paying 16%. And they will be building 9 townhouses. They've lodged their approval with council. They lodged that earlier in the year, and they expect that to come in the new year, and then construction will start then. So for those who are looking out for Bowral construction draws, that'll be something for the new year. Anything to add there, Joe?
No, look, I think you've covered that quite well, Xander. I mean, just look out for the construction draws in the new calendar year.
The second new loan we're going to be discussing is the Junction. So this is the Junction in Ipswich, Queensland. We've got a first mortgage paying 10% and a second mortgage paying 17%. The LVR on this one is 80.5% for that second mortgage. The Junction is the third, or this stage is the third and final stage, and they'll be building 42 townhouses. In the previous 2 stages, they built 70 townhouses. So we've got good comparable sales. They've sold 64 of the townhouses in the previous stage, and they're selling the other ones in the coming weeks. And construction has already commenced on stage 3, so that commenced around a month ago. So we've already paid that first construction draw. So we're very happy with how the Junction's going, and we look forward to more construction draws coming through. Anything to add there, Joe?
I think that you've summarised it very well. It's shovel ready. You've got comparable sales validating the ability of the sponsor to deliver to program and to prices that support the independent valuation. So and they're building a product that there's a chronic shortage of. So I think it's a really good opportunity, the Junction.
And for those who are interested, that second mortgage will be opening again with those construction draws. So feel free to put in your interest, and you can be first in line for those construction draws. And then the final new loan is Narangbar. This is in Queensland. We've got a first mortgage paying 10.5% and a second mortgage paying 18%. The LVR on that second mortgage is 76%. They'll be building 42 townhouses, and they've lodged their development application with council, and we expect that to be granted in the new year, and similarly construction to start the new year. So for those who are looking out for Narangbar construction draws, that'll be something in the new year similar to Bowral. Moving on to the completed stock. So we've got Yallambi loans. It's a residual stock deal. We've got a first mortgage paying 10.5%. With Yallambi, we have 2 more lots to sell. This loan is expected to end in November. So depending on sales in October and November, they might need a slight loan extension, but due to how they've sold so many and there's only 2 more to go, this extension would only be a very minor extension. And then moving on to Samford Rise, another residual stock deal, paying 10.25%. There were no sales in September, but as interest rates are expected to keep falling down, and this is quite a premium product that they are selling in Samford Rise, we expect sales to continue maybe at 1 a month going forward. But no, we're extremely happy with how Samford Rise is, and with that no construction risk, no planning risk, 10.25% is quite a good return to just sit while they sell down those completed land lots. Anything to add on Yallambi or Samford Rise, Joe?
Look, nothing. I think you've covered it quite well. Look, I think as you said, it's all completed stock. There's no construction risk. It is a dress circle location, particularly Samford, so slightly higher prices, and we'll just enjoy the yield while they sell down over time.
And then finally, I'll just do a quick comment on the real estate credit fund. For those who are new, the credit fund has paid 9% per annum since inception. We have 2 redemption windows for the fund, the 15th of March and the 15th of September. For the next redemption window will be the 15th of March, and you do have to give 1 month's notice for redemption. There's 3 main things I do want to highlight with the fund. There's the set and forget aspect of the fund. So you don't need to worry about when Tingalpa is finishing or what stage of every development each loan's in. And the part of that is you're fully invested. So when Tingalpa does repay, you might have to sit in cash units for a little bit, where with the credit fund, you'll stay fully invested and earning that 9%. And then the third and final thing is that diversification. The book is 15 loans at the moment. So you've got great diversification across the portfolio. Anything you would like to add to that, Joe?
No, look, I think you've summarised it well. The set and forget, the diversification, and always being invested at that 9% rate. I think it's a very good fund.
Well, thank you for watching the October portfolio update, and we look forward to seeing you in November. Thank you, Joe.
Yeah, thank you, Xander. All the best.